the higher the price of silver goes, the more important silver will become because why would central banks want to hold silver in their vaults at 20 or $30? But it's at 300 or even 1,000.
I mean, I think if gold keeps going up, silver will go up faster, and that will reduce the ratio. Where I think the short-term target to aim for is something like 50 to 1 silver to gold. Prices will go down and people will rush into assets which can protect themselves. Obviously, and that would be part of the bigger thing why silver already probably is at $100 and gold is probably at $5,000 or $6,000 by then.
Yeah. And I would say though that, silver's up 100% this year, gold 61.
A financial fault line is widening beneath the global markets, and silver is emerging as one of the clearest signals that something major is shifting. Mario Innecco emphasizes that silver becomes increasingly attractive to central banks as its price rises, transforming from a relatively ignored asset at lower valuations into a strategic reserve candidate at much higher levels. He highlights the long-term weakness in the gold-silver ratio, noting that historical precious metal bull markets often end with silver dramatically outperforming. With bond markets in a secular bear phase and global debt needing constant rollover, Innecco argues that even a small portfolio shift toward physical metals could overwhelm the limited supply. Clive Thompson describes the recent surge in silver as extraordinary, noting how quickly it has risen and how sustained momentum could theoretically push it into triple-digit territory within the next year or two. He expects silver to continue outpacing gold, compressing the gold-silver ratio toward shorter-term targets around 50 to 1. Thompson also explains that government debt is expanding much faster than wages or living costs, creating a growing imbalance that will eventually overwhelm investors' willingness to absorb more sovereign bonds. When yields rise to politically intolerable levels, he believes central banks will be forced into yield curve control buying government debt with newly created money to prevent a crisis. Their perspectives outline a converging narrative, a fragile global financial system under strain from massive debt loads, weakening bond markets, and growing investor interest in hard assets. They each arrive from different angles, but both see silver and gold gaining structural importance as governments face mounting fiscal pressures and central banks move closer to aggressive monetary interventions that could redefine the next phase of the precious metals cycle. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
The higher the price of silver goes, the more important silver will become because why would central banks want to hold silver in their vaults at 20 or $30? But it's at 300 or even 1,000 becomes more interesting. What's your view on that, Clive?
Well, I mean, it's just been an absolutely amazing week, and if it carries on at this pace, by sometime middle of next year, it will be over $100 and probably $200 in 2 years' time. I can't even. Well, looking a week ago, we were at $48. Where are we now? We're at $58. $10. It's maybe 10 days. $1 a day, really.
Yeah, 58.36 was the close on the spot. And also the gold, I'll bring it up right away now. We look at some charts. Well, oh, here it is. The gold silver ratio looks very negative, which is bullish for silver and bullish for precious metals in general, because since the Bretton Woods system was broken apart, whenever you have precious metals bull markets, silver does really well towards the end of the bull market. I think, yeah, in 1980, the ratio got to 16 to 1 right here. And then in 2011, got down to around 30 to 1. And I'm not saying the bull market is about to finish, but as you've seen here, this level here, I've been watching 73 and we closed at around 72. And this is a monthly chart. So longer term, it looks really, there's still so much room for silver to uh, outperform gold.
I mean, I think if gold keeps going up, silver will go up faster, and that will reduce the ratio. Where I think the short-term target to aim for is something like 50 to 1 silver to gold.
Short term, yeah, I agree, and I wouldn't discount seeing 15 to 1 again. Some people think that's impossible, but uh, if you go further back in 1968, it was also 15 to 1 or 16 to 1. And the other thing that I think is happening, Clive, is that uh,
That's enough.
the bonds are in the bear market. They've been in the bear market since 2020, in my opinion. You know, the 40-year bull market we had in bonds, that's over. And yes, the TLT, which is ETF for like representing long-term treasuries around 20-year maturity. Yes, it's up slightly on the year, but you can't really compare it to gold and silver. And I think, Clive, it's not just treasuries, but also corporate bonds and other kinds of bonds. There's so much debt around, Clive, that I think every year the bond market has to reissue like 27 trillion because a lot of these bonds mature and they have to roll it over. And the gold and silver market, the new issue of, or new production of gold and silver is less than a trillion. So, I mean, people are gonna tell themselves we need to have some gold and silver, even if they don't buy like 20% of their, let's say, portfolio into gold and silver. But if they decide to lift it to 2% from nothing, or even five, that's huge.
I mean, the rate of expansion of government debt is going faster than the people's wages, faster than the cost of living. So government debt and debt generally as a percentage of what's on the planet is becoming a bigger and bigger proportion. And ultimately that means that we get to a point where people get to an indigestion level and they say, I don't want any more of this government debt. And that's when the yields will start to rise to unacceptable levels. When that happens, probably the central banks will be invited to step in and act as buyer of the last resort, what they call yield curve control, where they buy government bonds by printing money to try and keep the rates from rising any further. And I think that's coming next year.
Yeah, I think what we're gonna get is financial repression, Clive. We're gonna have prices rising at 4 or 5%, and they're gonna keep rates at 3 or 4. So that's like they're gonna really debase the value of people's savings. And if you don't have any gold and silver or even copper here, someone's asking my price forecast for copper. Well, looking at this chart, it looks like it's going to go a lot higher, Clive. It's at all-time highs. This is high-grade copper futures. But so
I'm just
I don't
looking.
know. I mean, the sky's the limit here.
Yeah, I've been saying that copper should probably start to rise in the middle of next year, but it looks like it's well ahead of the curve now.
Yeah,
I see on the futures 54 $5.46 per pound, I guess that
yeah,
is.
yeah. It's just broken out of this. It
And
looks
it's
similar to
uh,
silver.
yeah, it's not. I mean, on my chart, it's not quite broken out. It needs to go above 650, something like that. But it's heading in that direction, and the trend is upwards.
Oh yeah, it's the Bloomberg Commodity Index. Here it is. In 2020, we had that COVID crash of everything. I think gold and silver picked up before the commodities, and then commodities caught up. And up until recently, we've been in a consolidation, but it looks like it's breaking out as well. So, and that is going to be, well, that's going to be inflationary or is going to lead to higher prices, if you want to call it that. And yeah, and I think the central banks, especially, I heard something about Japan, Clive. If the average yield or cost of financing for all Japanese government bonds goes to 2%, that means that all the tax revenues that the Japanese government gets is going to go to just service the interest on the debt.
Mario Innacco explains that even dramatic rises in gold or silver prices alone wouldn't fundamentally shift the economy, as higher costs for items like solar panels or electric vehicles are minimal. What truly matters is when all commodities rise together, signaling sustained inflation that pushes bond yields higher, lowers bond prices, and drives investors toward assets that preserve value, making silver near $100 and gold in the several thousand range plausible. He highlights the striking performance gap this year, with silver doubling and gold up over 60% versus the Nasdaq's modest gains, reflecting a shift in investor psychology as financial stresses mount. Innecco also notes that structural changes, such as a forthcoming executive order allowing portions of the $9.3 trillion in 401k retirement funds to flow into gold, silver, and mining stocks, could inject significant new capital into the relatively small physical metals market, amplifying momentum and demand. Clive Thompson argues that rising gold or silver prices alone won't shift the economy, but a broad surge in all commodities signals real inflation that drives yields higher, pushes bond prices lower, and channels investors into assets that protect purchasing power, making silver near $100 and gold in the several thousand range plausible. He warns that Japan's rising yields and weakening yen are destabilizing the carry trade, increasing global financial risk. Overall, he stresses that with mounting market stress and metals already breaking out, many investors are chasing missed opportunities, waiting for pullbacks that may never come. Let's get back to the interview.
Well, just because gold or silver reaches a much higher price doesn't mean to say that anything has to happen in the economy. Of course, if you're going to buy solar panels, it'll cost you more. If you're going to buy an electric car, it might cost you $20 more or something like that for the car. But nothing much is going to happen to the economy because the silver price is higher. What's more important is if the price of all commodities goes up. Now, if all commodities goes up, then we have an inflation, a serious inflation starting, and that means in an inflationary environment, bond yields will go up, bond prices will go down, and people will rush into assets which can protect themselves. Obviously, and that would be part of the bigger thing why silver already probably is at $100 and gold is probably at $5,000 or $6,000 by then.
Yeah, I mean, that's a good question because back in 1980 and 2011, the rise in silver to record highs coincided with the dollar crisis of late 70s, early 80s, and then 2011 it corresponded with the Southern European sovereign debt crisis. So, yeah, I mean, it could be to do with the Japanese government bond market and the carry trade. Someone just asked here, high silver. Will Japan bonds last till Christmas? Yeah, I think they'll last till Christmas, but they could continue to drop in price. They're still compared to yields in the UK, US, and other countries, they're still relatively low. But yeah, the Bank of Japan owns like half of all the long-term bonds. So yeah, they can afford to sit on losses. But it could, yeah, spill over into other markets because if the Bank of Japan also raises short-term rates, that's going to make the carry trade more difficult to keep on because in the carry trade, investors and speculators they borrow in yen to buy higher yielding assets. But if the cost of borrowing yen goes up, they have to get out of that and sell their assets. So it could create a lot of volatility all around the world. That's what I see. What do you think about the Japanese market, Clive? And someone today contacted me and said, "Have you looked at the Swiss franc versus the yen?" And it's almost as bad as gold in yen. It's
Yeah,
appreciating massive. It's almost at 200 yen, the Swiss franc, and it's gone from 60 yen.
I mean, the yen continues to go down despite the higher yields on Japanese bonds, and that will be hurting those who've in the carry trade, because they want the yen to go down, and they want the borrowing cost in yen to stay down. So the ideal situation, if you're doing the carry trade, the way it works is you basically borrow Japanese yen at the lowest possible rate, and you buy a higher yielding currency and invest in their higher rate bonds. Now, if in Japan we've got yields going up, it means your borrowing cost is going up. And if the Japanese yen, the falling Japanese yen is helping them for the time being. But if that reverses itself because of the higher interest rates, of course, there's going to be a lot of people which are hurt.
Yeah. And I would say though that silver's up 100% this year, gold 61, and I think the Nasdaq is only up 16%. But anyway,
Well, there you have. What are you
yeah,
going to bet on? Bet
yeah,
on the silver and gold. They're the ones which are running. There's a
yeah,
huge number of people who've missed the boat. They wish
yeah,
they could have bought. They wish they could have bought at 4,100, 4,000, 3,900, 3,800. So all these people who missed the boat are slowly raising their price in their mind, saying, if it just gets back to that price, I'll buy it. Oh, I missed
yeah.
it.
And also, you heard of the executive order for 401ks that could come into effect in February, and that's going to unleash 9.3 trillion potentially. That not the whole thing, of course, but some percentage of that could go into gold and silver because and miners because right now you can't in a 401k invest in commodities.
Rising gold and silver prices alone may not disrupt the broader economy, but a sustained increase across all commodities signals significant inflationary pressures, higher bond yields, and a rotation of capital into assets that preserve value. Market dynamics such as weakening currencies, rising government debt, and structural financial stresses amplify the appeal of precious metals, while limited supply relative to potential inflows from sources like retirement funds further strengthens their market position. These factors together indicate that gold and silver are becoming increasingly central to investor strategies, with momentum likely to continue as both market psychology and systemic pressures drive demand higher. How might rising commodity prices and increasing investor demand for gold and silver impact broader financial markets, including bonds, currencies, and retirement fund allocations? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.